Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 2nd of September. So we come off the back of a week that had a big focus on inflation. We saw Eurozone inflation down to 2.2%. And at the time of recording this, I'm waiting for that core PCE inflation metric out of the US. But the big report really came from NVIDIA. Bumper earnings, but we saw the stock fall 7% off the back of that. And the question mark here is, how are markets shaping up going forward? I would say, given the fact that now all the Mag 7 names are out the way, I would say earnings season by and large can be put behind us in terms of the second quarter, and there can be a focus on the economics. And September brings a positive focus because September is expected to bring rate cuts across the board. We're expecting to see many a rate cut from some of the most dominant central banks. Key to that would be the Federal Reserve, and certainly the US will be a major part of today's show. Let's get into the big data for the week ahead. This, according to Trading Economics, are the big ticket items to be looking out for. You can see kicking off with that Caixin manufacturing PMI out of China, expected to remain within contraction territory on Monday. Tuesday, the ISM manufacturing PMI. We have got the final readings of the manufacturing and services PMIs over in the US, but it's going to be the ISM numbers that are going to be crucial. And key to that is keeping an eye on some of the underlying metrics, because the ISM figures also split out things such as price pressures. So price pressures, most notably within the services PMI figure, which comes out on Thursday, will be really notable. On Wednesday, we've got the Australian GDP figure, we've got the trade data and the Bank of Canada interest rate decision, and the JOLTS job openings figure from the US. So this kick starts to focus on jobs, and certainly that has really come into prominence of late. We've seen massive downward revisions in terms of the US payrolls numbers. We've seen upside in terms of the jobless claims numbers, and we've seen everyone thinking that we could be on the cusp of a recession, and part of that is the rise that we've seen in terms of unemployment. So the fact that we're seeing the jobs market coming back into play really should play a key role in terms of determining exactly how many rate cuts we think the Federal Reserves are going to enact going forward. There is a view as things stand that we're going to see 100 basis points worth of cut over the rest of this year, and then 200 over the course of this year and next year. That I think might have even shifted to 225. So it's these changes in terms of expectation that really do play a key role for the likes of the US dollar, for the likes of equity markets, for some of the commodity markets. And so we see the JOLTS job openings figure. We've also got, it wasn't down on Trading Economics as the high ticket item, but we've got the ADP payrolls number, we've got the jobless claims number, and then on Friday, of course, we've got the jobs report out of the US. We've also got the IV PMI out of Canada and trade data out of Germany. Oh, and the jobs data coming out of Canada. So plenty to sink our teeth into. Let's kick off with Canada, and we can see here that it is a very jam-packed docket when it comes to data from the Canadian region. And key to that will be Wednesday's interest rate decision and expectation. We're going to see rates cut from 4.5% to 4.25%, so 25 basis points cut. And we also see at the back end of the week the jobs data. So again, this is the kind of thing that should shape expectations for future actions from the likes of the Bank of Canada going forward. Now, in terms of some of the data worth looking out for, this is the outlook for Canadian inflation. And I find this really interesting because whilst there is a possibility of further disinflation for the near term, bear in mind we're within that 1 to 3% range that the Bank of Canada respects or targets. We're at 2.53, so slap bang in the middle of that. Well, 2 would be slap bang, but 2.53, very nice number. But there is a key thing to note here, and that is that if you look at the past 12 months and you split into two, there's the coming 6 months where we're going to see likely upside in terms of inflation, and then the 6 months before that where into next year we're likely to see downside. And you can see that in terms of the 6-month annualized figure that we see at the bottom. That rise that has happened over the course of the past 5 months highlights the fact that out of the past 6 months, there was just one reading that came in relatively low, and that was the June figure. And aside from that, we've seen some pretty chunky inflation prints coming out of Canada of late. And so, if we're looking at the trajectory of inflation going forward, you can say, okay, August, when we see that stripped out, there's a possibility of disinflation. That figure looks somewhere like 0.4. So we could see that 2.53 number potentially drop to, say, 2.3, 2.4, that kind of thing. So falling further into that target. But then beyond that, you're looking at September, where we've got a negative reading being stripped out. October, we've got a very minimal figure being stripped out. December in particular, where we've got a very strong downward figure being stripped out. January, where we've got a figure of 0. So essentially, this is the last move in terms of the disinflation pathway before we see, in all likeliness, roughly 5 months worth of upside in terms of Canadian inflation. Whether that changes the rhetoric around the Bank of Canada's ability to continue to cut interest rates remains to be seen. Now, the expectation as things stand is that there's a 100% chance that we see a rate cut this time around, 81% chance that we see a 25 basis points move, 19% chance of a 50 basis point move. And if you look beyond that, do we see any shift in terms of the view that, okay, well, inflation might move towards the upside and therefore it might cut back on the amount of interest rate cuts from the Bank of Canada? Well, wouldn't necessarily say so as things stand. So we're looking for 25 basis points in September, another 25 basis point cut in October, another one in December, another one in January. So there's this very clear pathway that they have an expectation that we see rate cuts every single meeting for the rest of this year. So potentially, maybe something will shift down the line, but as things stand, the key thing here is whether the Bank of Canada continues to reiterate this confidence that we're going to see such moves going forward and continuation of the easing going forward. Now, in terms of the Canadian dollar, it's worthwhile noting that if we're looking for interest rate cuts at every single meeting, we could potentially see further weakness in terms of the CAD. Now, this is the Australian dollar against the Canadian dollar. If I show you on, say, the weekly time frame, we can give you a little bit more granularity. So we can see here that we sort of based out here. We saw a retracement of, there is around about 61.8. We've since seen, let me just get it onto the right point. We've since seen a perfect 76.4 fib retracement, and now we're essentially on that next leg higher from here. Now, whether we just continue to push onwards and upwards from here remains to be seen, but certainly I would say, given the fact that we're, I wouldn't say halfway into it, but potentially halfway into it. I mean, look, we haven't overcome that prior high of 9268. So we are within the middle of a move, and sometimes the middle of the move can be the most interesting. People generally will try to find the tops and the bottoms of markets, but finding the middle can be the sweet spot. Now, where are we in terms of that middle? We have been in sort of consolidation mode of late, and so a break up through this near-term resistance level, which would be around your 9185 up to 9196. A break through that area will give us greater confidence that this consolidation is over and that the bulls are back in charge once again. Until that happens, there is a possibility that we continue in this recent vein, but hopefully the Bank of Canada will come out with a nice dovish statement and an interest rate cut that could set the Aussie CAD moving towards the upside once again. Next up, I wanted to bring you the outlook for the US. Now, like I said, it's a big focus on US jobs this week. And sometimes, I've been doing this long enough to remember plenty of occasions where we're talking about the jobs market, but people don't really care, right? Especially at times when maybe the economy is running well, the jobs market has been providing us with good data. We're not really at the risk of coming into a position where people think there's a crisis or overheating, and therefore everything's just ticking along. This is not that moment. This is a moment where people do really care about the data. And the reason for that is that we've seen weaker payrolls, we've seen higher unemployment, and we've seen massive revisions in terms of the payrolls. 818,000 jobs being struck off in terms of a revision for the year into March. And so these downward revisions all of a sudden start making us look back and thinking, well, all this time we've been talking about the US jobs market looking particularly strong. maybe it wasn't as strong as we thought it was. We'd had the wool pulled over our eyes with some dubious data. And so the question mark here is, do we see further weakness that would point towards a potential impending recession? Now, everyone's looking towards that unemployment rate as the key indicator around the recession. So if we see further upside in terms of unemployment, if we see another weak payrolls figure, that would feed into the narrative that the Federal Reserve really have to act and act in a very dramatic manner. So if we do see those kind of moves, you're looking at the possibility of a 50 basis point cut from the Federal Reserve. And so that could be good for stocks. That could be bad for the US dollar. And that could be good for the likes of gold. And so I wanted to touch on gold. I've got a couple other charts to just quickly show you. First and foremost, this is the outlook in terms of the sort of jobs market. So you can see here that basing out in terms of unemployment, but we're still at relatively low levels. So you don't necessarily want to say, oh, we're at 4.3%. This is an absolute crisis in terms of unemployment rate. You compare that to some other countries, it's not necessarily that high. And non-farm payrolls, you can see the trajectory continues to be towards a downside, but we are back at the kind of levels that had been exhibited prior to the pandemic. The participation rate similarly has climbed back up towards the norm and sort of stuttering of late. And crucially, that average hourly earnings figure moving towards the downside. Just quickly, let's look back and see what's expected on the average hourly earnings. So 3.6, so expected to remain. That could actually provide the basis for outperformance or a positive surprise if we see a downside move in terms of that average hourly earnings and we move to say 3.5. Again, that gives us a little bit more confidence that this proxy for inflation is moving in the right direction. It gives the Federal Reserve greater leverage to be able to move. This is the expectation in terms of interest rates going forward, according to the CME. And so we can see here wide expectation of a 25 basis point cut, but it's 2/3 and a third attributed to a 50 basis point cut. Beyond that, the base case scenario is another 25 basis point cut. In actual fact, it's split. I mean, the biggest single area of confidence comes for a 25 basis points cut. But if you tally up the move to 450 and the 425, then that goes over 50. So in actual fact, there's an expectation that we're going to see a 50 basis point cut within this meeting or the next meeting. And then beyond that, it seems to be a case that we're expecting to see 25 basis points from there on in. And so the view of how many interest rate cuts are going to happen really will impact things in terms of some of these key markets. Now, the one I wanted to bring to you is gold, because gold, I think, is a great market to be trading. It's one of the most popular for our clients in particular. And it's something that I think will benefit from interest rate cuts going forward. Now, the long-term outlook shows you it already has been doing so. And this has been, one of my favorite trades over the years, because this recent pandemic, the interest rate hikes that came afterwards in terms of the surge of inflation, has provided us with a rare occasion where we have interest rate cuts that are pretty much definitely going to come. Central banks do not want to keep interest rates elevated. It's not in their interest to depress growth for an extended period of time. And so whether inflation came down now, or maybe it was sticky inflation and we see rates higher for another year, ultimately the pathway was clear that we were going to see easing coming into play. And at periods where we see monetary easing, we typically see gold outperform. Now, there's a correlation between the likes of the US dollar and gold. I could simply put on the dollar index and invert it, but instead I've put euro dollar. So essentially, it is an inverted relationship where we essentially are looking for weakness in terms of the US dollar, and that would provide strength for gold. If we were to see the likes of the jobs data moving towards the upside, and so suddenly we don't necessarily think we're going to see a huge amount of interest rate cuts. Let's say we saw upside in terms of average hourly earnings and another strong reading in terms of payrolls, and we saw a move downwards in terms of unemployment. That would likely lift the US dollar. That would hold back the likes of gold, I reckon, for the time being. But once we see that dollar weakness coming into play, and we're seeing a move towards really sharp moves in terms of monetary policy. That's what should benefit the likes of gold going forward and point towards a breakout. Because certainly, as we can see here, let me just give you a bigger chart. As we can see here, the recent price action has essentially been one of consolidation towards the top end. We have not been able to break through this area, this zone of resistance between 25.26 and 25.31. And we're respecting it once again here, right? So if I look on the hourly time frame, we can see some pretty clear trends, right? So the first trend you're going to be looking at is this wider trend, right? So we're looking at these retracements, essentially a 61.8 there. Then let's try and get that absolute point. And then down here, another 61.8. And then within those moves, you see those intraday trends as well, right? So if we are looking at what position we're in at the moment, well, we're narrowing into the intraday move. And so the pullback we're seeing at the moment, I think there's a good chance that it is another one of those intraday moves. And we'd need to see a break below this 2512 to point towards a wider pullback coming into play. And in which case you'd potentially be looking out for this kind of move down here. So you'd be looking for the sort of 2500s up to 2506 kind of area. And so really that 24.93 would be needed to point towards a wider pullback coming into play. But for the near term, that key swing low on the intraday basis comes at 25.11 for gold. The key thing is, do we break through these support levels or do we break through resistance of 25.26 up to 25.31? The trend is your friend, and the trend does point towards a bullish breakout. This is a very mucky looking chart now that I've put all of those Fibonacci levels onto it, but nonetheless the trend is very much bullish, and certainly once we break through this zone, which I do think is likely to come before too long, then it points towards another period of upside here for this precious metal. And finally, let me bring you onto the Swiss area. So here we go. Here's some data for the Swiss. And key amongst those is going to be Tuesday, because we have the inflation rate and we've got that GDP figure for the second quarter. Crucially, that inflation rate is well below its peers, right? So 1.3%. There's an expectation that the SMB are going to be ahead of the curve. Well, they already are ahead of the curve. They've already been cutting interest rates, and their interest rates are very low already. They are not at the levels that we see for the other central banks. And so, if we're looking at the other major central banks, so the US 525 to 550, New Zealand 525, the UK 5%, Canada 4.5, Australia 4.35, the Eurozone 4.25, and the Swiss 1.25. So the Swiss are already well ahead of it, and their interest rates are already so depressed that they won't necessarily be able to cut interest rates for that much longer, right? Before they start getting into negative territory. They're not in a position where they've got, say, 5% interest rates. So soon enough, despite the fact that they've been cutting ahead of time, soon enough that starts to pivot and starts to, much like what's happening in terms of Japan, where people are buying the Japanese yen on the idea that they might hike by 10 basis points, whereas you've got them with just come out of negative interest rate territory and you're trading it against, say, the US dollar, where they've got interest rates of 5%. But the idea is that relatively, we're going to see rate cuts from the Fed, we're going to see rate hikes from the BOJ, and you start to see that dollar yen rolling over as a result. So the question mark here is, are we going to see that similar kind of move coming in for the Swiss? Well, for the time being, maybe we won't see a too dramatic move, because there is still an expectation that we will see the SMB cutting rates. You can see here, there's an expectation that we see a rate cut down to 1% for September. In December, another one expected to take us down to 0.75. And then a further one potentially in March as a coin toss, essentially, to go down to 0.5%. And beyond that, it looks pretty much exactly the same. So it looks like 1, 2, 3 cuts, 0.75 basis points worth of cuts over the course of the next 3 meetings, maybe 4 meetings, and then that could be it. So potentially that resurgence in terms of the Swissy may be somewhat delayed. It may not happen right now, but nonetheless, you do have that on your mind. And certainly when you see other central banks and they're outlining a more dramatic pace of easing, then you could still see that early part of that move playing out. In terms of the inflation chart that we have here, because of course this is what we're looking at, 1.29. You can see last time around we've got 0.21 being stripped out. You can see last month we saw minus 0.18. So certainly if we saw another figure like last month, we could see another move, another disinflationary move coming into play. But what's notable here is, much like I showed you previously with Canada, you can see here 2.18 is on that 6-month annualized figure at the bottom here. And that highlights the fact that we have seen a significantly higher level of inflation over the past 6 months than the first 6 months of the last year. And so you can see that as we move forward, if we start to see figures that are, anything like the numbers we've seen in the past 6 months, we could see inflation moving towards the upside once again. And that potentially could ease back on the expectation that we're going to see rate cuts. So in terms of the chart to watch, this is one that I have covered a fair bit, and that is the euro against the Swiss franc. The daily time frame shows you that, like I said, I think we're in the middle of a move here. And so we've got this clear downtrend in play here at the moment. We've seen a couple of days towards the upside here. But for me, it looks likely that we're trading within a bearish trend. You can see here 61.8, much like that prior chart I was showing you. Again, a 61.8. And now we're heading lower. So it's not like we've broken through support. It's not like we've broken through the 921 level or we've gone well beyond that or anything like that. You could say, if we're replicating this same pattern, you could say that we're currently somewhere like this, right? Where you see this consolidation phase, a retracement phase, and then you see a move towards the downside. Now, if we look at those kind of moves in the past, how does it play out? You see this rally or consolidation, then you see a breakdown through support. And one way of trading it is that you can look for this prior swing high, and particularly if it's a shallow retracement, and look for the breakdown through support and utilize that for your stops. Same kind of thing here, right? The breakdown through support, utilizing the shallow retracement and looking for the breakdown. What are we seeing at the moment? Well, we're seeing this retracement is coming into this descending trend line. And so we could see the bears coming back into play once again. Certainly, I would have greater confidence of this move lower if we see that breakthrough, that 9352 support level. But certainly, despite the fact that we're gaining a bit of ground, I think there's a good chance that we do see another move towards the downside from here for Euro Swissy. We've just come off the back of the latest Eurozone inflation data, and that all pointed towards plenty of optimism in terms of potential rate cuts from the likes of the European Central Bank. Sorry, I'm just trying to get the data at the same time. Here we go. Spain CPI down from 2.8 to 2.2. The German CPI figure has come down to 1.8, I believe. That's on a different calendar I'm looking at. And then we've seen the headline Eurozone figure also declining. That came down to, so the German number was 1.9 and the Eurozone figure down to 2.2 as well. So we're in the kind of area where we would expect the ECB to feel very confident that if they need to rescue the European economy, and certainly Germany's in a pretty difficult place, then they could move, and they could move in a forceful manner. They already have rates that are below their peers, but nonetheless, we're talking about Euro Swissy. I think if you're comparing the amount of rate cuts we're going to see going forward from the likes of the ECB against the SNB, that could provide the basis for further downside here for this currency pair.